Hello,
Good
can you
morning,
hear
sir.
me? Yeah, good
Good
morning.
morning, sir.
Yeah, we are welcome to another section of the class today. Then in our last class, we started with company income tax and we treated interest deductible. So where there is what related party. So where there is loan between what? Between parent company and subsidiary. So it was stated that according to the tax law, according to section 24 of CETA, the interest on the loan will be restricted to 30% of EBITDA, 30% of earning before interest, tax, depreciation, and amortization, which we did. So we are able to look at a question on that. So we'll continue from there, from that aspect where we stop. Then also, we also need to look at a scenario, what is called what? The expenses relating to non-taxable income. Expenses relating to non-taxable income. Expenses relating to non-taxable income. So what do I mean by that? So I think that one is not in the material. So well, let me just illustrate it. Expenses relating to non-taxable income or tax exempt income. So we know that income can either be taxable or non-taxable. And when you add both your taxable and non-taxable, that will give you the total income. It is only the taxable income that you are going to pay tax on. So what the law is now saying is that since you are not going to pay tax on the non-taxable income, on those income that are exempted from tax, so that means any expenses that you incur to generate those income should also not be allowed should not be allowed as an allowable expenses. So in simple terms, expenses related to non-taxable income will be what? Will be disallowed in the computation of what? Of tax liability. So it is now possible that these expenses may be a general expenses. General expenses in the sense that the expenses will relate to both taxable and non-taxable income. So where the expenses is general expenses, and the law have stated that you should what? You should disallow the non-taxable income. So in that case, you need to what? To separate the taxable from the non-taxable income from a general expenses. How do you do that? So we are going to use what? The formula. So to now get expenses that will be allowed, so where the expenses is general, that is total was provided. So that is where they provide us the total expenses. So what we now need to do is what? We are going to what? Use what? Separate what? The taxable from the non-taxable. Then how do we do that? So in order to do that, we are going to use to get what? So we are going to use a formula to get the expenses allowed for deduction. So to get the expenses that will be allowed for deduction, we are going to use this formula divided by, we are going to use this formula A divided by A plus B divided by A plus B multiply. So you now say multiply by C. A divided by A plus B multiplied by C. What is now our A? So you need to, where A is equal to taxable income, B is equal to non-taxable income. Then the C will now be the total, the general stroke total expenses. So this formula will now give you expenses, the amount that will be allowed for what? For deduction. If we know the amount that will be allowed for deduction, we can get amount to be disallowed. So amount to be disallowed will now be equal to total expenses minus results from above formula. So anything you get from the above formula, you are going to what? Deduct it from where? From the total expenses. That is from the total expenses, which is what? Which is represented by what? By this letter C. So with this now, you will now be able, this will allow you to what? To eliminate what? Those expenses that are what? That are non-taxable from where? From the general or total expenses. So that is how to. So you may be asked. So you may be given a scenario whereby what? And expenses will relate to what? Both taxable and non-taxable income. So it is only the one that relates to the taxable income that will be allowed. That portion that relates to what? Non-taxable income will be what? Will be disallowed. So take note of that. So that is what? That is, so those are what you are expected to know under what? Under the total or normal basis. Under the total or normal basis. Then apart from the total or normal basis, we have another basis. I told us we have 4 bases of computing tax liability. Then we have what? Another basis which is called minimum tax basis. So minimum tax basis can also be what? Adopted to what? To compute what? The tax liability of what? Of a company. So we also have this minimum tax when you are also talking about what? Personal income tax. So, but for company, so what is the minimum tax base? How is the minimum tax basis adopted? So before we look at how it is adopted, simply means the least or the lowest amount of tax payable by what? By a taxpayer in a relevant year of assessment. So minimum, as the name implies, minimum. That is the lowest amount of tax that you are expected to pay as a taxpayer, as a company. So according to what? To the company income tax liability. So that means it is possible that since it is the lowest, so where you have a scenario whereby you don't have tax to pay, so the rule of the minimum tax will be what? Will be adopted. So which is what? According to what? Section 33 of what? Of the Company Income Tax Act. So when are we now supposed to what? To adopt this minimum tax? So the minimum tax are adopted under 3 scenarios. So the first one is that what? Where the ascertainment of total accessible profit from all sources of a company result in a loss. So by the time, we are going to get our accessible profits after we have done adjustments using either the net profit approach or the turnover approach. So this adjustment now that we did will give us accessible profit. So where after you did the adjustment, the figure you arrive at happen to be what? A loss. You are having a loss. Instead of having a profit, the figure is giving you a loss. In that case, so it is expected that what? The company will be liable to what? To payment of tax on what? On the basis of what? Minimum tax. You are going to apply minimum tax, where accessible profit provide you a loss. After the accessible profit, you proceed further. You add what? You remove your loss relief, you relieve your loss, add balancing charge. You also what? Relieve capital allowance. What you have is what? Total profit. Also, another condition that can make you to apply this minimum tax is what? Where a company has certain total profit results in what? No tax payable. You may have a positive accessible profit, but because of what? loss that that the company is going to relieve, and because of what capital allowance that they are going to claim, that end up making the total profit to become what? To become zero. So the total profit now become what? Nil, zero amount. So where the total profit is giving you a zero amount, it is also expected that what? You are going to apply what? Minimum tax. Then the third scenario is what? Where the tax payable at applicable rate of total profit is less than what the minimum tax payable. So this condition now provide a condition under what? Under the computation of company income tax, that whenever you are asked for the computation of company income tax, it is also expected that well, you must also what? Compute minimum tax. Take note of that. When you are asked for computation of tax liability, you compute it at the normal rate, which is what? At the normal rate, either what? 20% if the company is a medium company, or 30% if it's what? A large company. And you also what? Compute minimum tax at what? Applicable rate of minimum tax. So you now compare the tax liability at the normal rate with the what? With the tax liability at the minimum tax rate. So you select what? Whichever is higher between what? The normal rate and what? And the minimum tax rate. So what that means is that so anytime you are asked for computation of tax liability, after using the normal rate, you must also what? Apply what? Minimum tax and compare. Whichever is higher will be selected. So the only time you may not compute it is what? Where the examiner states that what? You should ignore minimum tax. You may have a scenario whereby after the examiner has given you the question, will now tell you compute tax liability, you now put ignore minimum tax. In that case, you are not expected to compute. But where the examiner did not state that, please, it is expected that you must also compute minimum tax. Then how do we compute this minimum tax? So this minimum tax is computed as well at the rate of 0.5% of gross turnover. 0.5% of gross turnover less frank investment income. We know our frank. Who can remind us which income is a frank investment income?
Dividend.
Dividend, yes. So your minimum tax will now be 0.5% of multiplied by gross turnover less frank investment income less dividend. So what that means is that what this gross turnover is what? The totality of all the income from all sources. Totality of all taxable income from all sources is what? Is the gross turnover, is 0.5%. Please, this is 0.5%, is not 5%. It is what? Is 0.5 divided by 100, multiplied by what? Gross turnover minus frank investment income. So we give you what? The minimum tax amount. Also, the minimum tax was reduced to 0.25%. Instead of using 0.5, you can also adopt 0.25% in certain year of assessment. For what? For 2020 and 2021 year of assessment. This is due to what? The occurrence of what? COVID-19. This year, our year of COVID-19. So because government, they want to reduce the effect of COVID-19. So the minimum tax for those periods is reduced to what? 0.25%. Please. So when the year of assessment is either 2020 or 2021, we are not going to use 0.5%. We are going to use 0.25% as the what? The minimum tax rate. So it is not all companies that are liable to the application of this minimum tax. There are certain companies that are exempted from minimum tax. One of them is a company that is engaged in what? Agricultural trade or business. So Agro-Ally, a company engaged in what? Agricultural trade or business. So where they tell you that the company is what? It's an agricultural company or agro-allied company. So where they don't have a total profit. So that means in that year, that company is not going to pay what? Any tax liability. So this is what? A form of incentive to what? Agricultural business. Then also, a small company. So a company with an annual turnover of 25 million naira and and below within what? A relevant year of assessment. That is, a small company are also exempted from minimum tax. So that means small company will also not pay what? Tax at all. Then also any company for the first 4 calendar year of commencement of business. So any company, whatever the company, if they are in their first 4 calendar year of commencement, minimum tax will not be what? Adopted on their activity. Why? Because of government want to use this. Because they are just commencing, they may end up not making profit at what? At the beginning of the commencement. So government wants to use this to what? As a result of what? As a means of what? Incentive and what? And encouragement to what? To encourage what? And what? And motivate what? The company. So those are the what? That is how the minimum tax is being computed. So any question? Any question? Any question? Also, so advantage of minimum tax is just a means of what? Reducing what? The tax liability of a company. So that's the advantage that it will give rise to. So to reduce what? The tax liability of a company, and to also ensure that your government gets revenue from the what? The minimum tax advantage is to what? To raise revenue for the government, because where the company end up not making total profit. So government will still what? Will still get something from it, from those revenue, because what? Because they what? They need that money to what? To carry out what? The basic economic activity. Then before the Finance Act 2019, there is what we call pre-operational levy, which is usually payable by any registered company that is requesting for what? Tax clearance certificate. If you are a registered company, if you now request for tax clearance certificate, it is and you are yet to commence operation, but because you want to get tax clearance certificate, before Finance Act, there's usually a fee that is usually paid to the tax authority, which is what? 25% in the first year and 20% for subsequent year for the issuance of what? Tax clearance. So, but this particular fee has been abolished by what? By the Finance Act 2019. So nothing like what? Nothing like pre-operational levy again. So for what? When you are yet to commence operation and you want to request for what? Tax clearance certificate, it will be what? Issued to you once you have what? You have fulfilled all the requirements requested by what? By the relevant tax authority without what? Without paying any what? Any fee to what? To the tax authority. So this money has been what? Abolished, which is also what? A form of incentive to encourage what? To encourage company. Because when you it is not immediately that company register that they are going to comment, because of what? Certain logistic that also need to be what? To be taken into what? Into consideration. So those are the requirements that we are expected to know as far as what the company income tax is concerned. So any question? So we are going to go to some question on what? On the application of a company income tax. So we are looking at the first question, which is practice question number 1. We have Fortune Nigeria Limited, a reputable soap making company, is based in Lagos and registered over 10 years ago. The financial year end of the company is 31st December every year. The financial position of the company for the year ended 31st December 2023 was as follows. We have the figure in thousand, turnover, cost of sales, gross profit, other income. All are figures. Deduct admin expenses. So we deduct admin expenses. Admin expenses. Then we have director remuneration, staff salaries, rent, advertisement, transport and traveling, postage and communication expenses, public relations and entertainment, miscellaneous expenses, preliminary expenses, allowance for doubtful debt, insurance premium, stamp duties, pension fund contribution, sundry expenses, repairs and maintenance, depreciation, gift and donation, subscription, cleaning expenses. All are figures. So the difference between this and this is supposed to be, it was omitted from this question. It's supposed to be net profits. The difference between that 37,751 minus 37,751 minus 26,865, 10,886. There's supposed to be information here, net profit, which is what? 10,886. There's supposed to be 10,886 there, which is the net profit. So which was omitted. So please let us take note of that. Further relevant detail as follows. Included in other income was the sum of 850 and profit on disposal of assets. Salaries and wages included housing allowance of 10 senior management staff who were paid the sum of 200,000 each per annum. One quarter of expenses on rent was paid on the apartment occupied by the father of the managing director. Half of the advertisement cost was incurred on sponsorship of the television program, where airtime was allocated for the promotion of their product. Public relations and entertainment of 3,150 included the sum of 308 paid as commission to a sales agent. The breakdown of miscellaneous expenses is as follows. Cost of computer hardware, furniture and fittings, cost of fuel and lubricant, printing and stationery. Total. The amount incurred as gift and donation included donation to Egba Community for Town Law Development, donation to University College Hospital Ibadan, gift to humanitarian candidate for electionary campaign. Breakdown of the amount paid as subscription is as follows. Subscription of staff to the Institute of Chartered Accountants of Nigeria, 200,000. Subscription to Recognized Trade Association, subscription of staff to Nigeria Institute of Management. All are figures. Agri capital allowance amounted to 725,000. Required. Compute the tax liability of Fortune Nigeria Limited for the relevant year of assessment. We have to compute the tax liability of this company, Fortune Nigeria Limited, for the relevant year of assessment. So how do we now know the basis to be used? The first thing is that we have, first of all, establish the category of this company. So we know that this taxpayer is a company. So that means the principle of company income tax will be adopted. How do we know that? We have a Fortune Nigeria Limited. So after establishing that, we also need to look at under which category does this company fall into. As we know, we have three categorizations of company. We have either small, medium, or large company. So the turnover of this company happened to be what? 106 million. 106 million. So who can tell us what category, under which of the category will this company fall into?
Large.
Under which category?
Large.
Yeah,
Medium.
large. Medium. Some people are saying
Large.
medium. Some people are saying large.
Large.
Company. Who said medium? Somebody said medium. Who was that person? So it's a large company because you can see from the what? From the turnover happened to be what? More than 100 million naira. So and any company with a turnover of 100 million and above, any company with a turnover of 100 million and above is regarded as what? As a what? A large company. So this company is what? It's a large company. So because this company is a large company, so because this company is a large company, so we also need to establish which of the bases are we going to use. So we know we have information about the net profit, which I said was omitted here. So that means we are going to use the net profit approach. So we are going to use the net profit approach. So let me share permit me to So to share my, so we have what? So we are going to use the net profit approach. So we are going to use the net profit approach. I'm coming now, sorry. So we are going to use the net profit approach, which is what is expected of us to use. So the net profit approach will be adopted. So to adopt this net profit approach, so we are going to apply what is this now? I don't know it now. This one will come out. Okay. All right. So to adopt the net profit approach, so we need to what? To apply the principle. That's what? So we need to apply that principle of adopting the net profit approach. So what is the principle? So that is what? So looking at what? The adjustment of profit. So if you look at the question, so I will want us to what? To look at, to find a mix of what? Looking at the question. Then we have a Fortune Nigeria Limited. So that is the name of the company. So I'm going to write the name of the company out. So which is what? Fortune Nigeria Limited. So we are asked to what? Computation of tax liability for, so we now look at the year. What will be the year? So we are giving information for the year ended 31st December 2023. So our year of assessment will be 2024 year of assessment. So I have my 2 Naira sign in 1,000. I also have another one in 1,000. So because I have information about net profit, I'm going to start with my net profit. Net profit reported. So net profit reported from the question. So let's go to the, so as I told you, if you look at the difference between that 37,751 minus 26,865, so that will give us 10,886. That is the net profit. So net profit is 10,886. So when we are using, who can remind us, when we are adopting the net profit, what do we add? We usually add something according to the formula. So we add what? Somebody should remind us. Add what? Add, yes, disallowable expenses. So we now look at the question again to look at the expenses one after the other. So you can, I always advise students that what you do is, well, first of all, look at the expenses one after the other from in the accounts given to you. We have director remuneration. So if you have information on this, when you know what, you look at the information one after the other also, so that you don't omit any of those items. This is the allowable staff salary, allowable rent. We have information on it, but rent on it is allowable. Advertisement allowable, transport allowable, public relation, miscellaneous. So all these are allowable. We have preliminary expenses. Is it an allowable expenses? Preliminary expenses. What is preliminary expenses? Who can tell us? What is preliminary expenses?
These are expenses incurred before incorporating a business or before construction of a fixed asset or something like that.
Yes, expenses incurred before incorporating a business. They can also call it formation expenses. It is called preliminary or formation expenses. So those are the expenses incurred in the formation of a business. So when you want to form your business, so those are the expenses you incur. These expenses are what? Are not allowable. They are what? Disallowable expenses. Because it is expected that that expense will be what? Capitalized. You are going to charge it as what? As a fictitious or as a what? As a fictitious asset, which will be written off year in, year out. So you cannot what? They cannot allow allowable. So number one, preliminary expenses, 200. So you go to our, so let us go to our, so we have our preliminary expenses. So we have preliminary expenses, 200. Then after that, so let me go back. After preliminary expenses, I have allowance for doubtful debt. Is this allowable or disallowable? Allowance for doubtful debt.
Disallowable.
Disallowable. No, I told us only what? Specific allowance for doubtful debt is allowable. Only specific. That word specific must be there. So where the examiner did not put that word specific, so where it is general, so it will be what? Disallowed. So please, this information, the only one that will be allowed is what? If it is what? Specific. Specific allowance for doubtful debt. So, but this is not specific, it will be disallowed. So allowance for doubtful debt, 50, it will also be what? Disallowed. So we have what? Allowance for doubtful debt. Allowance for doubtful debt. So we have 50. So that is also disallowable. It's also a disallowable expenses. We also proceed further. So the next one we have what? Insurance premium. Is insurance premium allowable? Insurance premium. Is it an allowable expenses? Are you allowed to carry out insurance policy for your activity? Is it allowable? Oh yeah, now insurance premium. It is also an what? Allowable expenses. So the premium you pay to insure your business are allowable. Then stamp duties. Stamp duty is what? A disallowable expenses. So any form of taxation is what? Disallowable. So we have a stamp duty. It's also a disallowable stamp duties. So it's what? Disallowable expenses. How much? 20. Stamp duty, 20. We have it as well. 20. Then after the stamp duty, we also have again, after the stamp duty, we have pension fund contribution. This is allowable. Sundry expenses allowable. Repair and maintenance allowable. Depreciation. Is depreciation an allowable expenses? Depreciation. Is it allowable?
Disallowed.
No.
Allowed. Because your capital allowance will be claimed. So depreciation is also disallowed. Depreciation is disallowed. So depreciation, you have it as well, 650. That's also what? Disallowed. So 650 is also a disallowable expenses. So then we have what? After that, we have the next one, which is what? Gift and donation, allowable. Subscription, allowable. Then cleaning expenses, allowed. After you have dealt with the account, you can now go to the notes one after the other. You can now visit the notes so that you don't omit any item. Under the note, we have included in other income was the sum of 850 N as well, profit on disposal of asset. Profit on disposal of asset, this is what a non-taxable income.
Capital
It's
gain.
it's a non-taxable income. Because this is a non-taxable income, so it must be what? Eliminated. So we are going to eliminate that profit on disposal. So when you look at the format, under our format, after add disallowable expenses, we also normally add what? We add disallowable expenses. We also add what? Or add what again? Disallowable expenses and what? Who can remind us? Oh yeah, now we on the format I gave you, we add disallowable expenses and what?
Non-taxable income.
Non-taxable income. We also add. Are you sure? Are you sure it's non-taxable income?
Taxable income omitted.
Yeah, taxable income omitted. Taxable income omitted. You guys need to familiarize yourself with that format, please, because that is what you are going to need to. So taxable income, you also add taxable income omitted. Then after this taxable income, you less what? What do we less?
Non-taxable.
Yeah, non-taxable income. That is what? Included. Look at that word. Taxable income included. Please, where that amount has not been included as part of the net profit, please, you are not going to treat it to take note of that. Where it has not been included as part of the net profit is not going to be treated. Take note of that. So non-taxable income, it has been included. That is what? Profit on disposal of asset, 850. So we have it at profit on disposal of assets, 850. Then after that, we go to the next thing we have is what? Salaries and wages included housing allowance of 10 senior management staff who are paid the sum of 200,000 each per annum. This is what? All these are what? They are allowable. So this will be what? Taxable in the hand of what? In the hand of the employee. So they are allowable for the company, but become taxable in the hand of what? Of the employee. Then we have what? 1/4 of the expenses on rent was paid on the apartment occupied by the father of the managing director. Allowable, the one paid for the father of the managing director. Is it allowable? So, is it allowable? That portion that relates to it is what? Disallowed. I told you what? Any private expenses will be what? Will be disallowed. So you now go back to the account. How much is the rent? 2.1. So 1/4 of rent will be disallowed. So let us go to rent. So that will be what? 1/4. 1 divided by 4 multiplied by 2,100. So that will give us the portion that will be what? That will be disallowed. So which is what? 525,000. So that portion will be what? Will be disallowed because it's related to what? Private. Then after that, we are told that half of advertisement cost was incurred on sponsorship of television program where airtime was allocated for the promotion of their product. Is this portion allowable? Which of the advertisement did I tell us is allowable? Who can remind us? I told us that all forms of advertisement are allowable, except where it is what? Capital in nature. It is only when the advertisement is capital in nature that it will become what? Disallowable. So these are amounts that they are distributing
Your
airtime
network, sir.
to promote their business. This is not capital in nature. So the examiner just put it there to confuse himself. So this information is what is allowable. So that amount, all the advertisement costs are what are allowable. We also have public relation and entertainment of 315 included the sum of what 308 paid as commission to a sales agent. is commission to agents, salesmen. They part of their, after receiving their salary, they also give them a commission for what? For selling what? For making sales. So this commission are also what? Are also an allowable expenses. So this information, the total what? The total public relation and entertainment is also allowable. So the examiner also put this there to what? To confuse himself. Then the breakdown of miscellaneous expenses included the following. The breakdown of miscellaneous expenses included the following. So we have a cost of computer hardware. Computer hardware is which form of asset? Which form of asset is computer hardware? I need somebody to respond. What form of asset is computer hardware? Is it a non-current asset or a current asset?
Is a
Computer. Is what?
non-current asset.
Is a non-current asset. So that means it is available for what? For capital allowance claim. Is that not so?
Yes, sir.
Yeah, so since it is going to be available for capital allowance claim, it's not going to be what? Allowed here again. So you are not, it's going to be what? A disallowable expenses. So we have what? Under disallowable expenses, miscellaneous expenses. So computer hardware. So how much is the computer hardware? So 680 is going to be disallowed. So we have a 680. Then after that, we also have again, so we have what? Cost of furniture and fitting. What category of asset is furniture and fitting?
Non-current assets.
It's also a non-current asset. It will be available for what? For capital allowance claim, 550. So that will also be what? Be disallowed. Furniture and fitting. We also have furniture and fittings. So we have it as what? At 550. Furniture and fittings, 550. Then after that, we have what? Cost of fuel and lubricant. This is what? This is a revenue expenditure. It is allowable. Printing and stationery, it is allowable. The amount incurred as gift and donation included the following. Donation to Egba community for town law development. Is this donation allowable? Egba community. Donation to club.
Disallowed.
Is what? Disallowed. So donation to Egba community, 360 will be disallowed. Donation to Egba community, donation to Egba community, 360,000 will be disallowed. Also, we also have next one as well. Donation to University College Hospital, Ibadan. Is it allowable?
It's
Yeah,
allowed.
allowed. Yeah. Gift to gubernatorial candidate for electionary campaign.
Disallow.
Disallowed. 490. Gift for electionary campaign. 490. Gift. Disallowed. Gift for electioneering campaign. 490. That will also be what? Disallowed. Then we also have again, we have breakdown of amount paid and submission of staff to Institute of Chartered Accountant of Nigeria. Is that allowable?
Allowed.
ICAN, yeah, it is allowed because ICAN is a recognized professional body. Submission to recognized trade association. Submission to recognized trade association. Is it allowed? Yes.
Allowed.
Yeah, it is allowed. This is what? This company, they are engaged in trading activities. So they are going to what? So belong to what? Association that govern what their business. So it is a submission of staff to Nigerian Institute of Management. Is NIM a recognized professional body?
Yes.
Yeah, it
Yes.
is also what? A recognized. So all these substitutions are also what? Allowable. It is only the one that is not recognized that will be what? That will be disallowed. So all these are what? Allowable. So the examiner just put it there to what? To confuse himself. Then agreed capital allowance amounted to 725. So that is what after computing what? The accessible profit. So we can now go to our accessible profit. So this is the total. This will give us what the total what? The total disallowable expenses. We add up all the total disallowable expenses to get the total amount. So we add up everything, the total disallowable expenses. So this will give us the total. So we add this to this. Non-taxable income, we don't have anyone, the 0. We also add this, so this will be what? Deducted from this, 850 plus 525. So that will give us minus 1375. So that will be deducted from this total amount. So we also have less, after less non-taxable, we usually less something again. What is that? We less non-taxable and what? What do we less again? Apart from non-taxable income, what do we less again? Yeah? We also less what? Allowable?
Capital allowance.
Allowable expenses? Omitted. So we also don't have this should be 0. So the resulting figure now will now give us accessible profits. Accessible, or you can call it what? Adjusted profits. Accessible stroke adjusted profit, which is 10,886, 13,886 minus 1375. 13,886 minus 1375. So that will give us 12,511. So we should be what? Our adjusted stroke accessible profit. After that, you now less what? Less loss relief. So in this question, we are not giving loss. So that is what? That will be 0. So, but in the exam, where you don't have all this information, you don't need to put them or place. Where you don't have all this taxable income, where you don't have non-taxable, so you don't need to include it. I'm just putting it because we are using it as an illustration. But in examination, you don't need, so where you don't have any, you don't need to put it. Then we also have add what? Balancing charge. Add balancing charge. So this is also not available. So you now less what? Less capital allowance. So under the capital allowance from the question, we are told that capital allowance for the year amounted to what? 725,000. So we have a capital allowance 725. Capital allowance for the year. So we have a 725,000. So capital allowance relief. So capital allowance is usually restricted to what percentage? Who can remind us?
66 to third.
66 to third. So we now find 2/3 of this accessible profit. 2,511 times 2 divided by 3. So that value is more than this 725. So in that case, so there is not going to be any restriction. So the value is giving us 8340, which is even more than the value we want to claim. So that means we are going to claim the entire 725,000. So we remove the 725 from here. We also remove it from here. So which is what? Minus 725. So capital allowance. So this will give us capital allowance carry forward, which will be what? 0. This will be nil. Then we now have what? Total. So we now have the total profit. So the total profit will now be 12,511 So the total profit will be 12,511. So the total profit will be 12,511 minus 725. So that will be 11,786. So which will be what? Which will be our what? Our so which will be our total profit. From this total profit, we can get our company income tax. So we already know that this company is what? Is a large company from its turnover. We have said that. And the rate of company income tax for large company is what percentage? Large company, what is the rate of their company income tax?
30%.
So at what? 30%. So that would be what? So that would be 30% of 11 of this 11, 30%, CIT at 30%, CIT at 30% multiplied by 11,786. So that will give us 35. So that will give us 35.8. Because the examiner did not say ignore minimum tax. So you are now going to apply minimum. You also calculate your minimum tax. And our year of assessment is what? 2024. So the rate of minimum tax will be what? Is 0.5% at 0.5% of our gross turnover. So in that case, our gross turnover will now be, let me go back to the question. My gross turnover will now be, gross turnover I told you is the totality of all the income made by the company. So the gross turnover will be what? Turnover, which is 106,000, plus other income. Other income is also an income. So we make plus what? 2,750. So we give us the gross turnover. But included in this other income is what? Is non-taxable income of 850,000. So this non-taxable income will be what? Will be eliminated before calculating what? The gross turnover. Less what? Less the non-taxable income of what? Minus 850,000. So we give us what? The gross turnover. So our gross turnover will be what? Will be 10. So turnover, which is 106, plus other income, which is 2,750, less non-taxable income that is included in that other income, less 850,000. Then we now say less of frank investment income. In this question, we are not giving what? We are not giving dividend. So in that case, so there is no what? So no dividend will be what? Will be deducted from the gross turnover, because of this question did not have dividend. So 0.5% of what? Of turnover. So let me analyze it out, which is what? 10 what? 10. So our turnover is what? So turnover 106,000, which is 106,000 plus add other income, which is how much is the other income? 32 other income, which is what? 2,750 less non-taxable income. So we have non-taxable income of 850 that is included in that other income, 850,000. So this will give us the what? The gross, so gross turnover now. Gross turnover will now be the resulting figure that we have here, which is what? Which is summation of this information, 107,900. So which will now be 0.5% of 107,900. So 0.5% of this figure will give us what? The gross turnover. So the gross turnover, which is what? Which is So 0.5. So our minimum tax will now be 0.5 divided by 100 times 107,900. So times 107,900. So that will give us what? 539.5. So which one do I tell us that we are going to select? Which one do I say should be selected between the minimum tax and the normal tax liability?
The
Which one are
highest.
we going to? The highest. So our
The one that is there.
yeah, CIT will now be, so we select the higher, will now be what? 35.8. So will be what? Will be selected. So as the final tax liability. So which is what? The CIT. Then we also have what? Tertiary education tax. So which is what? At the applicable rate, which can either be 2%, 2.5, or 3%. So this year of assessment is 2024. The rate for 2024 is what? 3%. So this rate will be what? Will be given to you by the examiner at the back of your question paper. So you don't need to stress yourself. Just look at what? The back of your question paper. You are going to meet this rate there. So which is what? Tertiary education tax apply on what? Accessible profit will be 3% of what? Of our accessible profit of 12,511. 3% of 12,511 will give us what? The tertiary education tax. 12,511 and 0.03. So that will give us 373,375.33. So we should be what? The tertiary education tax. You also close this. So that is what? How to compute what? The tax liability. So please, in the exam, where the examiner say total tax liability, if the examiner say total, instead of separating them individually like this, you are going to add these two together and get what? And get the total here. But in this question, the question did not say total. The question just say tax liability. So it will be separated individually. So let us take note of that. So any question? Any question? So that is how to compute what? The tax liability of what? For a what? For a company. So which what? So we have dealt with what? Both what? The turnover basis and also what? Sorry, we have dealt with what? The total basis, which is the normal basis, and what? And the minimum tax basis. We also have other basis of computing company income tax, which is what? We have the turnover basis, and we also have what? The dividend basis. So the turnover basis can also be adopted to what? To compute what? The company income tax of what? Of a taxpayer. So when are we supposed? So when can you adopt what? The turnover basis. Another basis that can be adopted is what? Turnover basis. So under this basis now, instead of using the normal basis or the total profit basis, so the tax authority is going to use what? The turnover as the basis of what? Determining what? The accessible profit of what? Of the company. How do they do this? By what? If this scenario will be adopted where the tax authority feel that the profit reported or the turnover reported by what? By the company is what? Is not what? Is not realistic. Where they find out that what? The accessible profit or the profit reported by that company is what? Is unrealistic. In that case, they are going to use what? A turnover basis by what? By applying a reasonable percentage on the turnover. How are they going to do that? They will look at, okay, if for instance, let's say Globalcom and MTN, in a particular year, Globalcom is reporting a profit of 200 million in a particular year. That same year, MTN now came. MTN is now reporting a what? A profit of what? 20 million without any what? Any unforeseen circumstances or contingency. And their counterpart in the same business is reporting what? A profit of 200 million. So the tax authority is going to disregard that their profit, and they are going to charge them using what? Turnover basis. So in that case, they are going to apply what? A fair percentage, certain percentage on what? On the turnover to determine what? To determine the accessible profit. So this turnover basis will be adopted where the tax authority feel that the turnover reported, feel that the profit reported by the company is unrealistic and not reasonable, in line with the industry standard. So if they find out that it is unreasonable in line with the industry standard, so in that case, they are going to use what? A fair percentage. A fair percentage will be adopted on the company turnover to arrive at the accessible profit. So that's how to adopt what? The turnover basis. So let us take note of that. You can just, so in that case, the examiner will give you what? That a certain percentage, maybe they will give you the percentage. That's what they want you to adopt if they want you to apply the turnover basis. So apart from the turnover basis, we also have another basis, which is what? The dividend basis. So the dividend basis is also another basis that can be adopted to determine the tax liability of a company. This is adopted in the following scenario, whereby number one, where the company did not is reporting loss, where there is no total profit. So there is no total profit, but the company is paying dividend. So where a company did not make a profit, but they are what? They are paying dividend in that what? In that same year of assessment. The tax authority is going to adopt what is called what? Dividend basis. So the tax authority will now assume that what? The dividend paid will be what? Will be used to replace what? To replace the total profit. So in that instance, the dividend paid will be assumed to be the total profit. So the tax authority are going to assume that that dividend paid by the company is their what? Is their total profit. So they are now going to apply what? They are going to apply what? The applicable rate, which is either 20% or 30%, depending on what? On the category of company to determine the company tax liability. So, but there are certain exemptions to this dividend basis, so that it may not be adopted. So where it can be claimed, one of the exemptions is that where it can be claimed that that dividend is paid from where? From retained earnings. So where the company can show that that dividend is paid from where? From their retained earnings that has already been subject to tax. In that case, so the dividend, so the application of what? Of that rule will not be what? Will not be adopted. So this rule is according to what? To certain section. So the dividend basis. So we have what? The dividend basis. So I'm coming. I want to try and remember that section. Hey, yeah, the dividend basis, which is section 19, which is according to section 19, section dividend basis, which is according to section 19 of theta. So why this turnover basis? This one is according to what? Section 33. So turnover basis is what? According to section 30. Yeah, section 30 of theta. So the dividends, so the tax authority are going to assume that that dividend paid is what? Is the total profit of the company. So they now apply what the applicable tax rate. But if the company can prove that what the dividend is paid from their what? From their retained earning, so the dividend will not be subject to application of what? Of this section 19. Or if it can also be proved that what the dividend is paid from where? From a tax exempt income, from income that are exempted from tax. Also, where it can be claimed that it is paid from where? From a frank investment income. So the dividend will not be what? Will not be subject to what? To applicable or to section 19 of the law. But where it is not what? Where those information cannot be what? Cannot be proved. So the tax authority is going to what? Also base what? The company activity using what? Using dividend basis. So those are the other bases that can be adopted for the computation of tax liability of a company. So let us also look at what? Another illustration before what? Before we end the class. So we are looking at question number 3. So let me share the question number 3. So we have XYZ Nigeria Limited was incorporated in Nigeria on November 1, 2016. The company has an authorized and fully paid ordinary share capital of 5 million share of ₦1 each. The company is a medium-sized entity that started trading on January 1, 2023. Retailing engineering equipment. Its first statement of profit or loss was for the year ended 31st December 2020 and revealed the following result. Gross profit, investment income, profit on sale of equipment, all are figured. We have less expensive depreciation, director emolument, debenture interest, audit and accountancy, legal cost, salaries, miscellaneous expenses, net profit. Then we now the following additional information was provided by the company financial director. Legal costs comprises the following: retainership, cost of issuing director service agreement, cost of issuing ordinary share. The breakdown of miscellaneous expenses comprise cost of installation of new machine, extension of and partitioning of office apartment, staff party, cost of entertaining supplier. Investment income comprises the following: dividend from Nigeria company net, loan interest from Nigeria company gross, non-trading. Loan interest for exactly 12 months was received for the year. So total loan. On December 31, the director of the company agreed to pay a dividend of 5% on his ordinary share. Balancing charge agreed with revenue was 2740. The agreed capital allowance with the revenue was 10325. Required, compute the total tax liability of XYZ Nigeria Limited for relevant year of assessment. Then B, explain other basis of assessing company to income tax in Nigeria apart from the normal basis. Looking at this question also, how do we know that we are supposed to adopt the normal basis or total? So because we are giving information about net profit, whenever you have a question on company income tax, the first basis to be adopted is what? The normal basis, which is what? The first basis to be adopted for the computation of what? Of the company income tax. So that is the first basis to be adopted when you are computing what? Company income tax. So this basis will be what? Will be the basis to be adopted for computing what? The company income tax. So to compute the company income tax, we are going to use net profit basis as well, because since we have information about the net profit, so that basis will also be what? Will also be adopted by us to compute for the company income tax. So let us look at, so let me. So we have the name of the company as what? So the name of the company, SYZ Nigeria Limited. SYZ Nigeria Limited. So we have the company. SYZ Nigeria Limited. Computation of tax liability. So this one now is asking computation of total tax liabilities for. So if you look at the question, we are giving information for 2023 December, for 2024, it will now be for 2024 year, for 2024 year of assessment. So we have net profit reported. The net profit reported from the question happened to be, so we also have in thousand, 31,025, 31,025. So which is the net profit? All in thousand. So we have the 1,000 figure. So we are going to add what? The same way we did, add disallowable expenses. So these disallowable expenses, let us go to our information. So we have what? Expenses, we have depreciation. Is depreciation a disallowable expenses? Depreciation.
Is disallowed.
Is it? Yeah, disallowable. 17,875. Depreciation. 17,875. After depreciation, we have the next one. We have director emolument. Is it allowable? Director emolument. Director emolument. Yeah, it is allowed. Debenture interest, allowed. Audit and accountancy fee, allowed. Legal costs, allowable. Salaries, allowable. Miscellaneous expenses. All those are allowable according to the note. So we now go to the account. We now go to the notes. The following additional information was provided by the company financial data. Legal costs comprises the following. Retainership fee. Is retainership fee allowable? Retainership. I told us that what? Every company must have what? A legal advisor as part of their what? Their representative. And to keep that legal advisor, they're going to be paying what? Retainership fee or legal advisory fee. So that is what allowable. The cost of issuing director service agreement. Cost of issuing director service agreement is also what? Is also an allowable expenses. So it's also allowable. Cost of issuing director service legal is also allowable. Cost of issuing ordinary share. So this is what? This is
Disallowed.
disallowed. Issuing ordinary share 2.5. So cost of issuing ordinary share is disallowable. So cost of issuing ordinary share. Issuing ordinary share. So disallowed 2.5. Then after that, we have the next one to be the next information from the question. We have it as the breakdown of miscellaneous expenses, cost of installation of new machine. Is that allowable? Installation of new machine.
Disallowed. It needs to be capitalized.
Is capital in nature. Installation of new machine 3750. Installation of new machine. Then after that, we have the next one, extension and partitioning of office apartments. Extension and partitioning of office apartment. Is it allowable? Extension and partitioning of office apartment. You have to look at it that is it capital in nature? Since they are extending it, that is what? Capital in nature. So that is also be what? disallowed. So 1.5, extension and partitioning 1.5, extension and partitioning 1.5. So after that, we also have again staff party. Is staff party allowable? Staff party? Yeah, it is allowable. Staff party. After staff, cost of entertaining supplier. So entertainment. So you are entertaining. So that is also what? Allowable. It is also allowable. Entertainment. So because they are your supplier. So it is business related. So entertainment of what? Of non-what? That is non-business related will be what? Disallowable. Then investment income comprises the following. Dividend from Nigeria company. Dividend is what form of income? Dividend is what form of income?
Frank investment.
Frank investment income. So frank investment income. So it's going to be what? Under the non-taxable income. So less. So you now say less non-taxable income included. So we have a dividend. Please. So according to the question, let me go back. I want to point out something to us here in the this dividend from Nigeria is what? It was given to us net. So that means they adjusted it on the net profit in net form. Please, when you want to remove it also, you also remove the net amount. Don't go and gross it up. You will also remove the net amount. So which is what? 2,100. So dividend, 2,100. So dividend, 2,100. So will be removed. 2,100 will be removed from that. We have what? Loan interest from Nigeria company, gross, non-trading interest. Any form of interest is what? Is a taxable income. So that is not a frank investment income. So that is also what? That is a taxable income. Also, from this account, after the gross profit, we have investment income. We have profit on sale of equipment. This is also what? A non-taxable income that has been included. So this amount is a non-taxable income. 4,950, profit on sale of investment is also a non-taxable income. Profit on sale of investment. 4,950. 4,950 is also what? A non-taxable income. So then those are the non-taxable income that are available from the question. So from there, we'll get what? So we can get what? Our adjusted profits. So we add up. So we add this. So this to this. I'm going to add this to this. All this will be added together to get this. So this one will be added to that. This and this will be added together. So I'm going to less this 21 plus 4,950 minus less this 7,050. So the resulting figure will give us accessible stroke adjusted profits, which is what? Which should now be what? The resulting figure of this and this. So from the question, let me go back to the question. We are giving balancing charge, no loss, but we have what? Information about balancing charge. So we have what? Information about balancing charge. No loss. We are giving info. So the next note, they told us that balancing charge agreed with revenue was 2,740. So we are going to take care of that. So we add that. So it's an additional income. So if you are giving balancing allowance, what do we do? Add balancing. Who can tell us?
We less it.
Yeah, you add it as part of your capital allowance because it is an additional capital allowance. Take note of that. Balancing charge, 2740. So we add it to this, 2740. We add it to this. So after the balancing charge, so you add this and this together. So after that, we now say less capital allowance. So under the capital allowance, from the question, we are told that capital allowance happen to be, agreed capital allowance is 10,325. So capital allowance 10,325. Then capital allowance relief, we are going to restrict it to what? To which percentage? 2/3 of accessible profit. So 2/3 of 49,600 times 2 divided by 3. So that value is more than this. Is more than this value. So we are going to charge the entire amount. So we are going to remove the 10,325. So we remove the entire amount, 10,325 from here as well. So the resulting figure will give us capital allowance carry forward will be nil. It will be nil. So the resulting figure will give us a taxable profit. So the taxable profit will now give us the resulting figure of this minus this. Will give us the taxable or total profit, which is the taxable or total profit. So this taxable or total profit is what you are now going to apply your tax rate on. So we apply our tax rate on the CIT at, so what will be the rate of CIT? So we go back to our question to know if we have information about what? About turnover. So are we giving information about turnover from the question? So let me go back to the question. In this question, the examiner did not give us turnover. The examiner only gave us gross profit, investment income, and profit on sale of equipment. No turnover was provided. So, and I told you, where turnover is not provided, you assume what? What do we assume? Where we are not giving information about turnover, what do we assume? Who can remind us where we don't have information about turnover? Large company, we use what? 30%. Thank you. So we use 30%. 42,015 times 0.3. Yeah, we are going to use 30%. So 30% will be adopted. So which is what? 12,604.5. So the resulting figure, 12,604.5. So we give us the resulting figure for that, for the company income tax. From the question, I think I saw something about, we also need to what? To calculate minimum tax. So, but we cannot calculate minimum tax here. Why? Who can tell us the reason why we can't calculate minimum tax here? Why can't we calculate minimum tax? Because from the question, we are not giving information about turnover. And minimum tax is what? A rate of gross turnover. So, but we don't have the turnover. So that means minimum tax will not be calculated. So your CIT will still be what? 12,604.5. So the question is asking us for what? Total. So you now have what? Tertiary education tax at, so the year of assessment happened to be 2024 at 3%. So that will be at 3% of accessible profit. 49,600. So we give us the 49,600. So 3%. So that will give us 1488. So we give us the tax. So this will now give us total tax liability. So you add it together where the examiner say total. But where the examiner did not say total, we separate it as what? As individual items. So take note of that. So this will give us what? Total tax liability. So you close the what? The figure. So as well for the total tax liability. So that's how to what? To compute what? The tax liability for what? For a what? A company. So computation of what? Total tax liability of a company. So any question? Any question?
Yes, sir, please, I want to confirm something. There was this question that we remove police development levy. So in what situation are we supposed to be removing that?
Remove.
Like that tax police development levy.
You remove or you calculate?
We calculate rather, yes.
Okay. For the purpose of computation, when they ask you for computation of tax liability, the examiner does not expect you to compute all those one as well. It is in practical scenario that what those will be what will be computed. But the tax liability examiner expects you to compute our minimum tax and the normal tax liability, the company income tax, and the what? The tertiary education tax. So it is when you are doing practical scenario that what the police is also an additional tax that is based on what? That is calculated, that is payable by company for a certain period of time. But you are not expected to calculate it. So when you are asked for a computation of the tax liability, it is only so you may only where the examiner asks you to also calculate it. So that is when you calculate. So don't calculate it. So any other question? Any question? So in the absence of no questions, so this is where we are going to end the class today. So we are going to continue next week. So have a lovely day ahead. Take care. Thank you.
Please help us
I'm going to
send the
I'm going to send the